But let's get talking on the personal finance corner. Hemant Rustagi of Wiseinvest Advisors joins in to talk about how exactly we should assess whether or not how our portfolio is doing. Hemant, thanks for joining in. So that is my first question to you. What exactly would make it a viable option for one person to actually exit an investment they've made, and how would you assess the performance of an asset class?
Well, I think as an investor, all of us want good performance from our portfolio. But to actually figure out whether it's actually happening or not can be a little tricky. Now, for example, many investors get disillusioned by looking at negative returns in their equity portfolio and often equate it with poor performance. But the fact is that negative performance in the equity portfolio does not necessarily mean poor performance. Even the best of the fund manager will give negative return during a significant downturn in the market. Similarly, even a mediocre fund manager will give fantastic return when the markets are doing very well. So I think it's very, very important for investors to realize that they need to look at long-term performance and not base their investment decision on the short-term performance. You know, the right way to assess performance is to compare it with a benchmark. Now, we know that investors have different asset classes in their portfolio, like they have gold, equity, and then there is debt. Mutual funds have different options to allow investors to invest in these asset classes. And the fact is that each of the mutual fund scheme has a benchmark. Now, for example, for equity fund, the benchmark would be an index like CNX 50, 100 or 500. For debt funds, there are indices like Crystal Composite Bond Index or Crystal Composite Short-Term Bond Index or ICEX, CIBEX. So these are the indices which are there for debt funds. And in fact, for a common investor, I would say the benchmark could be the return that he gets from fixed deposit bonds and debentures. And for gold savings scheme, the benchmark is the price of physical gold. Apart from comparing the performance with the benchmark, I think it's equally important to compare performance with the peer group, which is the funds in the same group. Of course, one has to be a little careful about selecting the fund in that peer group. And it's important because many a times, as a category, as a group, in fact, these funds can tend to outperform or underperform a particular benchmark. Now, for example, if the benchmark has risen by 6 to 7%, let's say, and then the category average is 10%, any fund which has given a return of 6 to 7% has actually underperformed the peer group. So it's important to compare the performance with the benchmark as well as the peer group. Consistency in performance, I think, is again a very important part while assessing the performance. The beta of a fund actually indicates how the fund will move up or down vis-a-vis the benchmark. Now, for example, if a fund has a beta of 0.90, which means that it will fall by 0.90% if the benchmark were to go down by 1%. Then there is the standard deviation, which basically indicates as to how the returns are going to be, how volatile the returns are. A fund with a lower standard deviation means a lower volatility in return. Then there's also a Sharpe ratio which indicates as to what kind of additional return which has been generated by the fund manager by taking that additional risk. All these ratios are available on the fact sheet, which is available on the website of mutual fund and also many finance portals. So it's very easy for investors to actually go and have a look at it. Last but not the least, I would say investors need to look at total return, which is a combination of dividend or interest that they earn as well as the capital appreciation. Now, total return basically indicates as to kind of return one has earned from an investment over a period of time. Now, this can be expressed in two ways. One is the cumulative figure and second is the annual CAGR. I think one should look at CAGR, not the compound rate, because that does not necessarily give you a clear picture. Now, for example, a fund which has gone up by 150% over a period of 10 years does not necessarily mean that the CAGR would be 15%. So I think it's important to look at CAGR. So as I mentioned, clearly that measuring performance is very, very important, and it's equally important to measure it the right way.
Yeah, I accept that. I wonder if all of us will have the time to draw such a spreadsheet. And more importantly, Hemant, a large number of your viewers, including yours truly, are stuck with insurance-related investment products where measuring performance is quite a headache with so many service charges and mortality charges also included. But we will have to defer that discussion for a later date with you. For the moment, we take a break. Viewers have lined up with their questions. We are back with answers from Hemant. We are talking personal finance and we have some viewers lined up with questions. This one is in an SMS form. It's come from Kanishk Khanna from Mumbai. He wants to know what percentage of a home loan he is required to pay as margin money? Hemant.
I think the requirement of margin money for taking a housing loan, if the loan amount is more than 20 lakh, is 20% of the value of the property. And let me just add here that while calculating the value of property, the stamp duty and the registration charges are not taken into consideration. And if the loan amount is less than 20 lakhs, then the margin money can be up to 10%.
Okay, that's easily understood. Thanks a lot, Hemant, for joining us with those details. Since it's an SMS and we are not able to touch base with Kanish Khanna, we don't have follow-up questions.